You're watching the latest news from financialmirror.tv. The hangover has kicked in and investors have sobered to the reality that recession is here as global stocks were shaken down Wednesday, snuffing out a two-day rally. The yen and gold prices rose, while government bonds also climbed in a fresh bid to unload risk on the reality of recession. The FTSE Euro First 300 index of top leading shares fell nearly 3%, while Germany's DAX and Britain's FTSE both shed more than 2%. The recessionary fear was also reflected in MSCI's measure of Asian stock markets, excluding Japan. The Nikkei rose 1% after spending most of the session in negative territory. Analysts say the fears of an imminent financial meltdown have given way to economic worries, taking risk-averse investors back to the yen, which saw a stunning rise last week as panic descended ahead of the bailouts and coordinated central bank rate cuts. The dollar stayed weak after Federal Reserve Bank of San Francisco Janet Yellen on Tuesday said the economy appears to be in a recession. Still, measures by governments and central banks aimed at restoring confidence between banks appear to be helping to kickstart the healing process in money markets, which had gummed up after the collapse of Lehman Brothers last month. The interbank cost of borrowing dollars, euros and sterling fell across all maturities, the latest daily fixing from the British Bankers Association showed. Meanwhile, US crude plunged to a fresh one-year low of $76 a barrel, weighed by worries that a global recession would hurt demand. Demand for gold, however, was firm, helping push the precious metal up more than 1% to nearly $850 an ounce. Bank deposits in the European Union should be guaranteed up to a minimum of €50,000, rising to €100,000 by the end of 2009, the European Commission proposed on Wednesday in a bid to reassure investors. The reform was sparked by a string of bank rescues, such as Northern Rock in Britain, where there were long queues of depositors worried they would not get their money back. Germany and Ireland also rushed to issue blanket guarantees to depositors amid the worst financial market turmoil in 80 years. EU governments have already agreed in principle to raise the minimum guarantee required under the bloc's rules from €20,000 to €50,000. Many will up it straight away to €100,000 to soothe depositors. The Commission said lifting the minimum guarantee to €50,000 would cover 80% of deposits, rising to 90% with a guarantee of €100,000. European leaders pressed on Wednesday for an overhaul of global financial structures after Asia joined Western bastions of capitalism in bailing out banks to avert financial meltdown and tackle looming recession. EU leaders arrived in Brussels after committing €2.2 trillion to rescue European banks and break a logjam in money markets that has choked off lending in the worst financial crisis since the Great Depression. British Prime Minister Gordon Brown said the IMF has got to be rebuilt as there is a need for an early warning system for the global economy. German Chancellor Angela Merkel added that the IMF should take on a bigger supervisory role. The United States put its shoulder to the wheel on Tuesday by offering to take $250 billion worth of stakes in its banks, an astonishing move in the home of free market capitalism, which suggests an appetite for new regulation even there. Southeast Asian nations, backed by $10 billion from the World Bank, were the latest to join the rescue effort, agreeing to create a multi-billion fund to help banks. The economy is dominating the US presidential campaign, which sees a final debate between the candidates on Wednesday. Democrat candidate Barack Obama has accused Republicans of presiding over unfettered financial deregulation, while John McCain has sought to regain his footing on economic issues after drawing criticism for saying US fundamentals were strong. Denmark is paying a political and economic price for being outside the Eurozone during the global financial crisis. Prime Minister Anders Fogh Rasmussen reaffirmed his intention to hold a referendum during the current parliamentary term on joining the single currency. Today's interest rates in Denmark are about 1% more than in the Eurozone. Rasmussen planned to hold a referendum this year on ending Denmark's opt-outs from EU treaty provisions on defence, justice and home affairs as a prelude to trying to reverse a popular vote in 2000 against joining the euro. But he put off the plan after Irish voters rejected the EU's Lisbon Reform Treaty in June, highlighting the unpredictability of referendums on European issues. All Denmark's mainstream political parties support joining the euro, but public view is more divided according to opinion polls. European new car sales fell 8.2% year-on-year in September, despite 2 extra working days, as the fallout from the financial crisis hit auto manufacturers hard. Usually September is a strong month for car sales that tend to pick up after the calmer summer months, but the credit crunch is hampering the automotive sector's ability to finance its daily operations and invest in new technologies for greener vehicles. The Manufacturers Association, ACEA, renewed a call to governments to help fund the development of fuel-efficient technologies and said capital expenditure by car makers in the past decade had pushed them to the limit of their competitive edge. In addition, demand for new cars is weakening, with customers increasingly reluctant to make large purchases or unable to find lenders willing to finance them. The steepest declines were in the UK market, where sales fell 21%, and in Spain down 32%. General Motors recorded a drop of 18%, Nissan saw a drop of 5.2%, and French manufacturers Renault and PSA Peugeot Citroën posted declines of 2% and 9% respectively. Fiat European sales edged down 1.4%, and Volkswagen Group sales rose 1.4% to 263,435 units. British unemployment shot up at its fastest pace since the early 1990s recession this summer, and experts are predicting even bigger rises ahead as the financial crisis takes its toll on companies right across the economy. The ILO measure of unemployment rose by 164,000 in the 3 months to August, even before the year-old credit crunch tightened its grip in the last month. That took the jobless rate up half a percentage point to 5.7%, also its biggest jump since July 1991. Forecasts are for the unemployment rate to peak at 7.9% in the first quarter of 2010, while the number out of work, now at 1.8 million, could hit 2 million by Christmas. Construction and banking firms have been at the forefront of companies shedding staff in the face of the economic slowdown and housing market slump. Cadbury has just announced 580 job losses, and ITV is cutting around 1,000 jobs. Thank you for watching FinancialMirror.tv.